Derivatives are secondary securities whose value is solely based on the value of the primary security that they are linked to, called the underlying. Typically, derivatives are considered advanced investing. Simply, you can say that a derivative is a contract between two parties which derives its value or price from an underlying asset. Generally, stocks, bonds, currency, commodities, and interest rates form the underlying asset. Let's know the types of derivatives. First one is forward contract and future contract. These are also called forwards and futures. These are financial contracts that obligate the contract's buyer to purchase an asset at a pre-agreed price on a specified future date. Both forward and future are essentially the same in their nature. However, forwards are more flexible contracts because the parties can customize the underlying commodity as well as the quantity of the commodity and the date of the transaction. On the other hand, futures are standardized contracts that are traded on the exchanges. The main differentiating feature between futures and forwards contracts is that futures are publicly traded on an exchange while forwards are privately traded, results in several operational differences between them. This comparison examines differences like counterparty risk, daily centralized clearing and mark to market, price transparency, and efficiency. Number two is options. An option is a derivative, a contract that gives the buyer the right but not the obligation to buy or sell the underlying asset by a certain date at a specified price. There are two types of options. Number one is call option. Calls give the buyers the right but not the obligation to buy the underlying asset at a strike price specified in the option contract. Investors buy calls when they believe the price of the underlying asset will increase and sell calls if they believe it will decrease. Number two is put options. Puts give the buyer the right but not the obligation to sell the underlying asset at a strike price specified in the contract. The writer or the seller of the put option is obligated to buy the asset if the put buyer exercises their option. Investors buy puts when they believe the price of the underlying asset will decrease and sell puts if they believe it will increase. Number three is swaps. Swaps are derivative contracts that allow the exchange of cash flows between two parties. The swaps usually involve the exchange of a fixed cash flow for a floating cash flow. The most popular types of swaps are interest rate swaps, commodity swaps, and currency swaps. Interest rate swaps. Counterparties agree to exchange one stream of future interest payments for another, based on a predetermined rational principal amount. Generally, interest rate swaps involve the exchange of a fixed interest rate for a floating interest rate. Currency swaps. Counterparties exchange the principal amount and interest payment denominated in different currencies. These contract swaps are often used to hedge another investment position against currency exchange rate fluctuations. Number three is commodity swap. These derivatives are designed to exchange floating cash flows that are based on a commodity spot price for fixed cash flows determined by a pre-agreed price of a commodity. Despite its name, commodity swaps do not involve the exchange of the actual commodity. There is another kind of swap which is called credit default swap. A CDS or credit default swap provides insurance from the default of a debt instrument. The buyer of a swap transfers to the seller the premium payments. In case the asset defaults, the seller will reimburse the buyer the face value of the defaulted asset, while the asset will be transferred from the buyer to the seller. Credit default swaps became somewhat notorious due to their impact on the 2008 global financial crisis. So this type of swap is not very much popular among the investors.